Two people take out the exact same loan. Same amount, same interest rate, same day. One of them ends up buried in it, stressed, paying it off for years. The other ends up richer than before they borrowed a dime. Same loan, same rate, opposite outcome. So what's the difference? It's not the size of the loan, it's not the interest rate, it's not luck. It comes down to a single idea, one that wealthy people understand instinctively and most people are never taught. Here's the uncomfortable truth. Debt isn't the problem. Using debt like a broke person is the problem. The wealthy don't fear debt or worship it. They use it as a tool, guided by one simple question that changes everything. In this video, I'm going to show you the 6 ways wealthy people use debt to build wealth. From strategies you can literally start using this week, to the billionaire level moves you've read about in headlines. And I'll be honest with you the whole way about which is which, because this channel runs the numbers, it doesn't sell hype. By the end, you'll understand debt the way wealthy people do. Let's get into it. The one idea behind all of this. Before the 6 strategies, you need the one idea that ties them all together, because every single move you're about to see is just this idea with different numbers plugged in. Here it is. A loan stripped down to its core is nothing more than renting money. You borrow a sum, you pay a fee for the time you hold it, and you give it back. That fee, the interest rate, is just the rent you pay on the money. So the only question that actually matters is this. When you take that rented money and put it to work, does it earn more than the rent costs? If you borrow money at 5% and you put it to work earning 8%, you just kept the difference. 3% on money that was never yours to begin with. That gap between what the money earns and what it costs has a name. It's called the spread. And the spread is the whole game. Wealthy people don't look at a loan and think, how fast can I pay this off? They look at a loan and think, what's the spread and how much can I safely control with it? Same loan you're looking at, completely different question. That's the mental shift. Debt used to buy things that lose value and earn nothing. That's the debt that buries people. Debt used to control assets that earn more than the loan costs. That's the debt that builds wealth. Keep that distinction in mind because every strategy from here is a version of it. Let's count them down. Number 1, the float, getting paid before you pay. The first one is the oldest trick in business, and a version of it is something almost anyone can use. It's called the float, and it runs on trade credit. Imagine you sell a simple product. The beginner version is that you buy the inventory with your own cash, wait, and then sell it, but your money is tied up the whole time. The wealthy version is that you never pay for the inventory up front. Suppliers will often hand you the product on terms. Pay in 30, 60, or 90 days. They're effectively lending you the product for free. You sell it before the bill is even due. Collect from your customers, pay the supplier, and keep the difference. Run the numbers. How much of your own money was in that deal? Almost none. You controlled a whole batch of inventory using someone else's money for a few months for free. That's why selling is one of the most valuable skills on earth. The seller never needed money, they needed terms. And here's the part you can actually use. You don't need a warehouse. Anyone who gets paid before they have to pay for something is using the float. A freelancer who takes a deposit before starting a job. A service business that bills the client before buying materials. Even a 0% card that floats a purchase you've already got the cash to cover. Same mechanism, smaller scale. Get paid first, pay later, and keep your own money working in the meantime. Number 2, real estate, recycling your down payment. The second strategy is the one wealthy people use to build fortunes in real estate, and most finance content gets the math wrong. Here's the honest version. Say you buy a property that needs work. That's why it's cheap. You put money down, take a mortgage for the rest, and spend some cash fixing it up. At this point, a chunk of your own money is tied up in the property, but now it's renovated, and it's worth significantly more than you paid. So you go back to the bank and refinance based on the new higher value. The new loan pays off your original mortgage, and you pull the leftover cash back out, often getting most or all of your original investment returned to you. Here's what most people miss. You didn't just make a profit, you pulled your own money back out of the deal and you still own the property. Your cash is now free to go do it again somewhere else, while the first property keeps building equity and generating rent. That's the real reason investors love this strategy. It's not just the profit, it's that you recycle the same money over and over into more assets. Now the honest catch, because this is a numbers channel, not a hype channel, your new loan is bigger, which means a bigger monthly payment. Refinancing has real costs, and the whole thing only works if the rent covers that bigger payment with room to spare. The magic was never the refinance trick. It's finding a property whose numbers actually work after all the costs. That's the hard part nobody puts on a billboard. But this one is genuinely reachable. People with far less than you'd guess do exactly this. Number 3, buy, borrow, die, the billionaire strategy. The third one is the strategy behind almost every headline you've seen about a billionaire who pays little to nothing in income tax. It's not a secret loophole. It's 3 ordinary rules stacked together, and once you see it, you can't unsee it. It's called buy, borrow, die. Step 1, buy. You own assets that grow in value, stocks, a business, real estate. On paper, you're wealthy. But here's the key. Gains on paper aren't taxed. You only owe tax when you sell. Step 2, borrow. Since selling triggers the tax, the wealthy don't sell. Instead, they borrow against their assets. There's a real product for this. A line of credit secured by your investment portfolio. You pledge your assets as collateral, and the bank hands you cash to live on. You borrow at a relatively low rate, your assets keep growing at a higher rate, and you never sold a thing, so you never paid the capital gains tax that selling would have triggered. Borrowing at a single-digit rate to avoid a much larger tax bill is the entire point. Step 3, and this is the cold one, die. Under current law, when assets pass to heirs, the built-up gains can effectively be wiped clean at the new market value. A lifetime of growth that was never taxed may never get taxed at all. I'll be straight with you, this one isn't for you today. You need a serious pile of appreciated assets before a bank writes you that kind of credit line. But you needed to see it because the small version of this exact idea is coming, and that one you can run. Number 4, borrowing against assets and its dark side. The fourth thing isn't just a strategy, it's the engine underneath the last one, and it has a dangerous side you need to understand. When you borrow against your investments, the lender doesn't hand you $1 for every dollar you own. They give you a portion of your portfolio's value, and they watch it closely. Here's the risk. If the market drops and your collateral loses value, the lender can demand you put up more cash or more assets immediately, or they'll sell your holdings out from under you to cover the loan. That forced sale is called a margin call, and it's the thing that turns leverage from a tool into a trap. This is the crucial lesson about all borrowing. Leverage multiplies your results in both directions. A positive spread gets multiplied into a fortune, a negative one gets multiplied into a disaster. The same force that makes wealthy people richer can wipe someone out who used too much of it without a cushion. That's why the wealthy who use these strategies almost never borrow to the maximum. They leave a huge margin of safety, so a market drop is an inconvenience, not a catastrophe. If you take one risk management lesson from this whole video, it's that leverage without a safety buffer isn't a wealth strategy, it's a time bomb. Respect it. Number 5, the 0% arbitrage, the one you can run today. The 5th one is the small-scale mirror of that very first float strategy, except instead of a supplier lending you product, a credit card company lends you money at 0%. And this is the most do-it-today move in the entire video. Right now, balance transfer offers routinely give you 0% interest for well over a year, sometimes close to 2. There's usually a one-time transfer fee of a few percent, and that fee is the only real cost. So this isn't quite free money, but run the numbers. You're renting a chunk of money for a small one-time fee for a long stretch of time. Now here's the honest, boring, powerful version of this. This isn't a get-rich scheme. The most valuable use is moving high-interest debt off a card, charging you punishing rates onto one charging you 0. Think about the spread there. You're not trying to earn a few percent, you're erasing a brutal interest rate and paying a small fee to do it. That's a guaranteed return almost no investment can match, and it's completely within reach for a normal person. This is the one I most want you to understand because it's the same exact mechanism the business owner used with the float. Borrow cheap, use it wisely, keep the difference. The only thing separating you from the big players is the size of the number, not the idea. Number 6, your interest rate, the lever. Everyone can pull, and the 6th one is the move absolutely everyone watching can start on today. And it quietly powers all the others. Go back to the core idea. The spread is what your money earns minus what it costs. Most people obsess over the earning side. Chasing the perfect investment, the wealthy obsess over the cost side because the cost of your money is a number you can actually lower, and every bit you shave off goes straight into your spread. Your credit score is the single biggest lever on what your money costs. The gap between a fair score and an excellent one can be several percentage points on every loan you take for the rest of your life, on a mortgage, a car, a business line of credit. Over a lifetime, those points compound into tens, even hundreds of thousands of dollars. Here's the empowering part. Wealthy people don't have access to some secret bank. They have access to cheaper money because they made themselves cheap to lend to. And unlike picking a winning stock, improving your credit is almost entirely within your control. Paying on time, keeping your balances low relative to your limits, not opening too much new credit at once. These are boring, unglamorous habits, and they lower the cost of every dollar you'll ever borrow. That's leverage on top of leverage, and anyone can start pulling that lever this week. How to actually use this. So let's pull it together into what you can actually do. Starting now, start with the cost side, because it's the fastest win and it costs you nothing. Pull your credit score this week and find out what your money currently costs. Every point you raise, it lowers the rent on every dollar you'll ever borrow. Next, if you're carrying high interest debt right now, you're on the wrong side of the spread. You're paying punishing rent for no return. Flipping that to a 0% balance transfer turns a negative spread into a positive one, and it's something you could genuinely act on this week. And if you sell anything or run anything, use the float. Get paid before you have to pay. Take the deposit before you buy the materials. Use the terms your suppliers give you. Every time you do, less of your own money is tied up and your returns climb. The bigger strategies, the real estate recycling, the borrow against assets moves, those come later as your assets grow, but the mindset applies at every level. The billionaire with a line of credit and a regular person doing a smart balance transfer are running the exact same arithmetic. The only thing that changes is the size and the direction you point it. Here's the whole video in one line. Debt is just rented money, and the only question that ever mattered is whether what you do with it earns more than the rent. Get that on the right side, and debt stops being the thing that owns you and becomes a tool that you own. Get it on the wrong side, borrowing for things that lose value and earn nothing, and it quietly destroys you. That's the entire difference between debt that builds wealth and debt that buries people. Most people are taught only one lesson about debt. Pay it off as fast as you can, and for high interest, wrong side of the spread debt, that's exactly right. We've got a whole video on escaping that kind. But the wealthy know there's a second lesson. Some debt, used carefully with a safety cushion pointed at assets that earn more than they cost, is one of the most powerful wealth building tools that exists. You don't need to be rich to start thinking this way. You just need to start asking the question the wealthy ask. What's the spread, and am I on the right side of it? If this changed the way you look at the loans in your own life, that's the whole point of this channel. We run the numbers so you don't have to take anyone's word for it. Subscribe, because there's a lot more where this came from. Drop a comment below. Which of these 6 surprised you the most? If you know someone who's terrified of all debt, or someone drowning in the wrong kind, share this video with them. Understanding this one idea could change how they handle money for the rest of their life. Thanks for watching, and I'll see you in the next one. Let's build